In this tutorial, we're going to teach you how to trade from multiple time frame Fibonacci and from the exact edges. In this video, we're going to leverage all of the good information that you've learned about high probability trend trades and use that information to help us define counter trend trades on the smaller chart. So we're going to focus our attention on the chart on the left. So on the 14-2 chart, you can see that we've had a trend change on the larger chart. The small triggers have come down a long way, and you can see at the low, we have no divergence on this pivot. Now remember, when we have a strong trend change and there's a larger gap back to the synthetic triggers, traditionally we'll close that gap, and you can see when we do close that gap, we end up at multiple time frame Fibonacci resistance. So not only do we end up at multiple time frame Fibonacci resistance on the 14-2 chart, we also have multiple time frame Fibonacci resistance on our smaller 5-1 chart. It's at this very spot where we anticipate on the 14-2 chart a high probability trend trade short. Again, all of the rules being met. Synthetic triggers are down, price pulls back to mid bands in Fibonacci, our fib to fib oscillators at the 75 sell line. So we really have a very high probability trend trade short look on the large chart, which will enable us to use the multiple time frame Fibonacci edge with no triggers breaking through that edge to define an exact spot for a counter trend trade. The entry for this trade is very, very simple. The first down bar that you get on your market flow chart from that edge is your entry. So whether you place a stop order below the reversal bar marker so you get in immediately, or you turn the strategy on as you're reaching the area, so any reversal bar at the area will get you in. Very simple. You have to wait for confirmation from the 5 range chart, because if it never gives a reversal bar, the market could keep going to the upside. So again, the reversal bar from the multiple time frame Fibonacci edge is the entry for your counter trend trade short from multiple time frame Fibonacci resistance. The next pattern that we're going to look at is still using multiple time frame Fibonacci support and resistance. And what we're going to do is we're going to focus our attention on the 14-2 chart on the left, and we're going to focus our attention on the yellow box at multiple time frame Fibonacci support. Now, it's not the first test of Fibonacci support. This is a high probability second test of multiple time frame Fibonacci support. So you may have had your first trend trade way back to the left. It's during the retest of this area. You've got a couple of things that, again, I want you to really understand this because it's very, very important. This pattern repeats itself over and over and over on every single chart that we have with dynamic Renko bars. Literally every day, you're going to see this pattern. So it's at the yellow box, we have potential for divergence, and you can see we've got a negative 58 there. We also have our fib to fib oscillator at the 25 buy line. At the same time, we have a large gap back to our synthetic triggers. And at the same time, our small triggers have barely made any type of retracement to the downside. So we have really a lot of pieces to this puzzle. First and foremost is multiple time frame Fibonacci support. Second is divergence potential on the large chart. Third is fib to fib oscillator making a retracement back to 25. And then the fourth and fifth pieces are the location of our small triggers and synthetic triggers on the 14-2 chart. It's at this retest or this spot at 1650, 1660 that we're looking for some type of counter trend trade to the long side. When we move over to our 5-1 chart, you'll see that during this retest of this Fibonacci edge at 1660, we have not only Fibonacci edge, but we also have a prior divergence low pivot stop out. And when you can couple the look on the 14-2 chart, which is a very high probability that Fibonacci support will hold because of our trigger lines and fib to fib oscillator, couple that with a divergence pivot stop out on the 5-1 chart, you really end up with the first counter trend trade from the edges of multiple time frame fibs that will generate your first long trade. You'll also notice on the smaller chart, the 5-1 chart, that we have a large gap back to our synthetic triggers. This is also very helpful. Now, I'm not sure if you've noticed it yet, but the exact same pattern that we had on the 14-2 chart that caused the bottom also gave us a second opportunity for a second long trade if we had exited our first long trade. So let's take a look at the pattern on the 5-1 chart. And again, you really need to learn this pattern because this pattern repeats itself a lot. So starting from the lows, the market obviously goes up, and that was our first long trade. It's during the retracement that you'll notice that we reach multiple time frame Fibonacci support at 1730. We also have divergence potential that we'll be working on the chart. We also have the fib to fib oscillator at the 25 buy line. And as we retest this Fibonacci support with divergence potential, you'll notice that we have considerably higher small trigger lines, and we have synthetic trigger lines still above us. And while it's not exactly a double bottom in price like it was on the 14-2 chart, it's a very, 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 very consistent pattern that you'll see on our software, with especially when there's Fibonacci support and resistance. So again, just to review, the pattern on the 14-2 chart caused the first attempt at multiple time frame fibs. A push up, a retracement to retest the fibs. During the retracement, 25 on the fib to fib oscillator, much higher small triggers, much higher synthetic triggers, divergence potential, and we're going up. So again, entry at 1660 on the first long trade. If you wanted to take a second opportunity with the same pattern but from the 5-1 chart, that's also very acceptable. The market goes up. During the retest of multiple time frame fibs, fib to fib oscillator at 25, both the small triggers and the synthetic triggers considerably above multiple time frame fib support at 1730 creates a fantastic second opportunity for a second long trade. Now with those looks at the edges of fibs, again, we're using our multiple time frame fibs and we're using our patterns on our other charts, and all we want is a reversal bar on the 5 range chart. So if we're at a very, very edge, we can either use a stop order or turn on the strategy at the area. You'll notice on the second retest of that 5-1 chart, we also have a market flow long signal. So either of these two places is going to be perfectly acceptable as an entry area, number one, at multiple time frame fibs, and then using the market flow reversal bar patterns as an entry signal. To use yet again a very recurring theme that you've already learned on your trend trades. Remember when we have a very strong trend to the upside and our background color is green. If our small triggers get on the wrong side of our synthetic triggers, but we reach Fibonacci areas and midbands, we're going to get one more trend trade to close the big gap back to the synthetic triggers. We're going to be able to use this exact same look on our 14-2 chart to generate counter trend trades on our smaller time frame chart. So let's take a look at our two charts together. On the left, you see our 14-2 chart, very strong small synthetic triggers going up with a big gap. And we've hit Fibonacci support and a mid-band, and really all of our trend trade long rules are true on the 14-2 chart. As we take this area of the yellow box and we start to look at our 5-1 chart, again, the first thing that you'll notice is that our small triggers are coming down really, really strong, and we reach multiple time frame Fibonacci support. Now again, this one's not quite as easy for a new user because of the strength of the market coming to the downside. Again, you have to really practice and become very comfortable with this look on your large chart, providing a high probability that this fib support will hold due to the trigger line configuration. When you do that, you really start to fine tune and start to say, okay, where will I actually take a trade setup if I get a reversal? Now, let me show you one more quick pattern. And you remember our last pattern that we had? So hypothetically, you didn't take the trade. You recognized the trade, but you didn't take the trade. Do you remember the same pattern that we looked at just a minute ago where the market goes up and then the market pulls back with divergence potential, and at the same time the market has a pullback in the fib to fib oscillator to the 25 buy line? At the same time, our small triggers did not cross to the downside. So again, this is a little bit different because we don't have the big gap of these triggers. But again, this is a very, very, very familiar bottom pattern that you'll see in the market. Again, we're not going short after multiple time frame fibs are hit. What we'd like to do is go long from the edges if possible. If for some reason the overwhelming momentum to the downside, makes you miss the trade, as the market comes up and bounces down off of the mid-band, and you recognize the pattern that really it happens a lot. 2 or 3 bars down, small triggers do not cross to the downside. And you can see we bounce right off of our 165 EMA, this white dotted moving average. At the same time, our fib to fib oscillator is at the 25 buy line as a second chance opportunity to get in on this trade down here. Optimally, we'd like to be in at 1650 or thereabouts. If you get in closer to the 17 area with this pattern, this is still a really good opportunity for you to take advantage of closing the market. And again, I want you to really keep in mind perspective-wise where the big gap is. The big gap is up here. So the potential of this trade from 1650 is almost $400. And you can see it actually goes a little bit further, and we make a pivot stop out up here at the top, which would end any of our trend trade long thoughts. So again, just to kind of bring back a recurring theme, once you get a divergence pivot stop out, remember, with your trend trades, they become much lower probability. Now that we've got our trade set up from the edge of multiple time frame fibs, we need a reversal bar. So as we're trading down into the very obvious edge of multiple time frame fibs, we'll turn on the automated strategy. Just turn the longs on and buy next reversal bar. And when this reversal bar happens to the upside, the automated strategy is going to get you into your position to go long. And again, just it's worth noting, if for some reason you were not or did not take the initial long trade. As the market went up and pulled back with that pattern that we looked at on the 5-1 chart, you'll recognize that the market flow strategy also gave you another long signal. So if for some reason you missed the edge with the pattern that was on our 5-1 chart, this market flow long signal with the arrow to the upside would have been a fantastic second chance opportunity for you to take advantage of the edge of multiple time frame fibs and a high probability long trade from the 14-2 chart. The last pattern that we'll use for trading from the edges is when you reach a multiple time frame Fibonacci resistance, but the market is a little too strong when we reach that area initially. One of the things that we've talked about is if those triggers are very strong going into a multiple time frame resistance, make sure that your small trigger lines roll over first and are headed to the downside, and then the edge of multiple time frame resistance will have a higher probability of holding. So let's take a look at both of the charts together. So what you'll see again on the left, edge of multiple time frame fib resistance with very strong triggers going up, and then the small triggers roll to the downside. And when we look at our smaller chart, again, this theme, again, one more time for trend trade should resonate with you. You've seen this many times before. We have a trend change on our smaller chart, so the background color goes to red. We have no divergence on the pivot on the low, which means we're going to be looking for a trend trade to the short side. And again, you remember the theme of if the trend is really strong going up first and there's a larger gap back to the synthetic triggers on the smaller chart, let me just write big gap on there for you, that will have a tendency to close that gap before we'll actually head to the downside. Now this one went just a little bit further and actually made it back to the edge of multiple time frame fibs, which is what we want. Again, this is the spot where it starts to become tempting to do a trend trade. And if you do a trend trade here, and again, we'll have to take a look at what the market flow said, but again, this is not a bad spot necessarily. Obviously, once we close the gap on the triggers and then we reach the edge of multiple time frame fibs, again, this kind of becomes a trend trade from the wrong side of our synthetic triggers, which also is the edge of multiple time frame fib trade for us. So again, it's the process of recognizing the edge of fibs at 42.30, allowing the market to weaken and the triggers to roll over so we don't try to get short too early and get run over. Recognizing no divergence on the small chart first, recognizing the larger gap after a strong run up prior, and then reaching the edge of Fibonacci resistance. And again, this is the spot where we're looking for our trade setup on the edge of resistance. So when we go and we bring in the market flow chart at the same spot, again, this is the trend change to the downside. And again, if you ignore the big gap rule and needing to close the big gap back to the synthetic triggers after a strong trend up, you may end up tricking yourself into a short trade here a little too early. And again, our trend trade rules did not become true even on the 5-1 chart until we got to here. Actually, let me make a green box for you here so we can look at these two areas together because it's very important. Again, the trend trade rules did not become true until we were inside of this green box. So again, fib to fib oscillator must be at 75. And you can see that, as we started to reach resistance and our gap was a little above, obviously we went a little further. So again, talking about entries. Here's the rules being met at this yellow line right here. So this is the point on your chart or your market flow chart where you're turning on the strategy for maybe a trend trade short, give or take, somewhere right in here. And again, this is the very first bar to the downside that generates a sell signal. And again, this is one that you're probably going to take because it's only one tick from the resistance. So this is a good trade from the edge of Fibonacci resistance based on our other charts. Now again, I know we haven't quite gotten into the management rules yet, but the management rules for stops are pretty simple. We're trying to get in as close to the edge of Fibonacci resistance as possible. And we're looking for, usually on any counter trend trade, we're looking to at least make it back to the mid band on the larger chart before we start looking for bounces. So the target objective is from 42.30 down to about 38.60. And you can see that, if we get short somewhere around the 42 area, if we was, obviously being very patient, this pivot right here at the top, once this bar gets put into the downside, that's when we actually will trail our stop behind that pivot, and then the market will obviously make its down move. And we haven't gotten a lot into trade management yet, but once the market makes this little retracement and then another new bar down, we'll actually pull our stop down here. So we'll be able to bring our stop down behind each of the pivots, and then obviously if we were to hold longer, this would be the next pivot where we'd trail stops. So again, the process of reading multiple time frame fibs. We reached them initially on the 14.2 chart. Triggers are way too strong for us to use that area. As the small triggers roll down on the 14.2 chart, which are the synthetic triggers on the 5.1 chart, we reach the edge of Fibonacci resistance again. However, we have a much different trigger line configuration the second time. So this is where it becomes very high probability that this resistance will hold and start to take us down to the downside. And again, trading from the edges of Fibonacci resistance is one thing, and usually, almost always, when you have the edge of Fibonacci resistance hold and the market makes a strong down move, the next trend trade after that is almost always a winner as well. So it creates, a high probability edge at the Fibonacci resistance for us that subsequently turns into a high probability trend trade after that. So as you go back and study your charts, you'll see, go back and look at the edges of Fibonacci support or resistance. Anytime you get one that holds, usually is followed by a second trend trade after that. And again, for us, entry criteria wise, really the most important thing for us is to be at the right spot. Once we're actually at the right spot, then turning on the strategy and then turning on the buttons so we can take advantage of the market movement. So again, we don't really look at the market flow strategy or entry criteria until we reach the spot that we want to trade. Then, either this one, which would be, probably your entry, or if you really waited to the edge, it's only a one tick difference, then this one would be your entry as well. So it'd probably happen on the yellow one. And again, a 10 tick stop, you have to really think about your stop placement. Your stop's going to end up being up here. So you're going to avoid getting stopped out, and then after you get your pivot, you'll move your stop down, and then after you get new pivots, you'll move your stop down, and then after you get new signals to the downside, you'll move your stops down or take new trades, obviously, as the market progresses. So again, just to review, If you reach the edge of Fibonacci resistance and the triggers are very strong, you have to wait for the triggers to roll over, wait for the area to be retested, and then you can take advantage of the edge of Fibonacci resistance in this case, or support if it's coming from the bottom.